experts, great questions.
Coming off the back of the biggest weekly loss on the S&P 500 since September, trying to bounce going into two key risk events this week. CPI tomorrow, the Federal Reserve on Wednesday, and I'm sure you're sick to death of hearing that already. Equity futures right now positive by a couple of tenths of 1% on the S&P, on the Nasdaq 100, basically unchanged. Let's see opening bow, switch to the board and get to the bond market. Yields shaping up as follows on a 10-year, down by 5 basis points. So a 10-year right now, 352.87. In the FX market, euro dollar 105.58. We're positive there by 0.2 of 1%. And crude this morning was down for a 7th straight session. Now trying to bounce up by 1.4%, call it 1.5. $72 a barrel after coming very, very close to breaking into the 60s. About 20 seconds into this session, the S&P 500 positive by 0.2 of 1%. The Nasdaq up by a little more than 0.1 of 1%. One stock to watch at the open, Horizon Therapeutics, the company getting a bid from Amgen, a $27.8 billion price tag pushing the stock higher. Kelly Lyons has more. Hey, Kaylee.
Yeah, John, this is a big deal, big merger Monday. This would be Amgen's biggest deal ever, and obviously you are seeing the result of Horizon Therapeutics shares moving higher. Amgen, though, a little bit lower. Now, Amgen's argument here is that these portfolios complement each other. Horizon's portfolio includes a therapy for an autoimmune disease called thyroid eye disease, and that is a condition that apparently is pretty painful and can provide billions of dollars worth of revenue. So Amgen says overall this will provide a sales boost globally. Analysts, though, have kind of mixed feelings. Wells Fargo says the deal doesn't pass the test of Amgen's current needs. RBC saying it could take time to get a handle on the portfolio and is questioning the size. And on that size, that $116.50 share price tag is a 20% premium to Friday's close, a 48% premium to November 29th when Horizon first disclosed that it was in early talks with 3 suitors. Because remember, Sanofi and J&J also initially were in the running. They both dropped their bids, with Sanofi yesterday saying that the price tag had just gotten too high because the stock was trading sub $80 2 weeks ago. This morning, it's now trading up at 111, so even still shy of that deal price. But that is a 43% move in just 10 days. And what's interesting, John, is I would note this is not the only deal this morning. You actually have about $70 billion in deals announced through Sunday so far this week. So an interesting rush to get these things over the finish line before the end of the year, considering it has been such a slow year with deal volume down by about a third in 2022, John.
It has been so quiet, and investment banks want to see way more of this stuff next year. Kaylee, thank you. As always, Apple, another one to watch, getting a fresh dose of optimism, that's for sure. China lifting its high-risk COVID status in the area surrounding Foxconn's iPhone plant. That stock is up by a couple of tenths of 1%. Ed Ludlow has more. Hey, Ed.
Yeah, good morning, John. We're modestly higher, right? 0.2%. You're right. This is the Zhengzhou Airport Economy Zone, where basically Chinese authorities have decategorized that area as high-risk COVID zones. Therefore, we're getting optimistic, and a number of sell-siders have notes out about how this could improve production at the facility, which accounts for 4 out of every 5 iPhone 14 Pro handsets that are made. Citi has a note out having met with Hon Hai Precision, or Foxconn's management in investor meetings last week, saying that the commentary from them is that production will normalize this month, in the month of December. There are cautions from others. Oppenheimer, for example, cutting its price target to 170 from 190, saying that actually iPhone production capacity recovery in China might come a bit later than that. You look at what's happening in China right now. There has been a reaction to the easing of COVID restrictions, with cases spreading. There's been reporting on the Bloomberg terminal about how hospitals are struggling with that. Interesting table on your screen. Bloomberg's done an analysis of Taiwan-based iPhone or Apple suppliers and assemblers. Actually, in the month of November, across those names, revenue fell 6.4% in that month from a year ago. It's the first monthly sales drop for the group since April. So you kind of get that sense of the lingering impact that these disruptions from COVID in China have had for those assemblers, and the concern we still kind of have around Apple being able to produce the handset that's in demand, the Pro models.
Ed, since we went to China and production, let's finish on Tesla. It's down again today by about 2%.
Yeah.
It was down last week. Down by about 8% last week. Didn't have a great week at all, Ed. What's the latest for people in that stock?
Yeah, so there was a lot of debate about whether a pullback in production in Shanghai was related to sort of annual standard maintenance where you shut the assembly lines down in order to update them and upgrade them. That is something that Tesla has in the past timed to the Chinese New Year, which falls in January, but Bloomberg reported this is an action Tesla's taking right now. Bloomberg also reported that they were cutting the shift hours from 11.5 to 9.5 in Shanghai and stopped onboarding new assembly line workers. So what I'm hearing from investors, what you see in the sell side notes as well, is they just want something from Tesla, from Elon Musk, from management, just to say, is this a demand issue, so you're pulling back, or is this just standard practice to pull back the assembly line? We don't have anything from Tesla, and that's part of what the concern is around the stock. That and, of course, the kind of lingering effects of Musk's financing package to buy Twitter.
We were both asking the same question through last week. It is the question right now for what's happening in China. Ed, thank you, buddy, as always. Looking forward to the coverage a little bit later. The stock for Tesla down by a little more than 2%. The broader equity market concerned about one thing, what happens with earnings in the first half of 23. You know the growing consensus on the street right now. An earnings downturn is coming and will bring the S&P down with it. It's the view from Morgan Stanley's Mike Wilson, writing a final chapter to this bear market is all about the path of earnings estimates, which are far too high in our view. From Goldman's David Kostin writing the following: earnings could fall next year due to more margin compression than we expect. And from Clear Harbour's Aaron Kennan, who writes the following: there exists a rising probability that we see earnings falter in 23. This would create an environment of rising downside risk for equities for the year. A more pronounced recession with earnings following that trend could see the S&P 500 closer to 3,000. Aaron, I'm pleased to say, joins us right now. Now, Aaron, there was a lot of coulds, maybes, ifs. Let's talk about some of them. How much earnings pain are you forecasting for early 23?
Right. So, John, thank you. Good morning. Our base case is for a lackluster earnings picture, but it's not for the 3,000 number. We think if you look at consensus, if we end the year 221 earnings per share for the S&P 500, which looks like it's sort of in the cards at this point, estimates right now across Wall Street are about calling for about $230 of earnings next year. On average, 1 year forward, those earnings estimates tend to be inflated relative to reality by about 7%. So that takes us back down below 220 to, let's say, 217, which is essentially a flat earnings year for 2023. That's sort of my base case, sort of with my strategist cap on. But there is a thesis, of course, that if we enter a recession, and earnings we know peaked probably in 2021, margins peaked in 2021, and growth looks lackluster for this year, that, there is a thesis that we could see a 15% decline in earnings. And if you put a multiple at trough on that, at 14 or even 15, that takes you to 3,000 or less. It's not our base case, but we're very mindful that that's a risk out there in the market.
We always hear about a low versus the low. I think we heard it from Julian Emanuel of Evercore over the weekend in his note, and he said this, and I'd love your thoughts on it, Aaron. He said the bear market lacks the cathartic volatility spike present at the end of every bear market since 1970. Such a spike, the bottom, not a bottom, arrives in mid-23 with a lower low as economic and earnings recession forecasts become reality. Aaron, could you explain what was lacking about the low that we've seen so far through 2022 that doesn't make it the low of this bear market?
Well, it may indeed be the low, and I certainly hope that it is. But we have an inflation picture that is still unclear to investors, unclear to the Fed, and we have an employment picture which speaks to maybe some softening there on the margin. And the outcome for geopolitical uncertainty, whether it's the energy impact on Europe and the ability for Europe to even function from an industrial perspective due to massive input costs, the uncertainty on the picture in China, as you already referenced this morning. There are a lot of variables out there, a lot of sort of fat tail risks, so to speak, that will impact this market. And so the notion that we're going to end the year unchanged almost seems like a silly one, given all of the pronounced volatility that we're seeing around the capital markets landscape.
The dip and rip, we've heard it a million times, haven't we? You and I both over the last month. You dip in the first half, you rip in the second half as the Fed has to back away. I was going through your risk factors for next year. The number 2 risks, year next year, one by one, I'm going to go through them with you. Elevated inflation for longer was 1, and 2, a more pronounced recession with earnings following that trend was 2. So we've dealt with 2, let's deal with 1. Elevated inflation for longer. Aaron, from your perspective, what is elevated? Is it 3, is it 4, is it 5? What is it? What's problematic?
Right. Well, the long-term inflation expectations are, below 250 if you look at 10-year break-evens. And we have inflation in the short term that's still extraordinarily pronounced. And you have the PCE data point, which the Fed really looks at, that deflator. And if you look at PCE at 5 with a 5% handle on it, we've never seen PCE drop 1.5 percentage points to even that 3% type level, or 3.5% type level, never mind 2 and 2.5, unless we've had a recession. We haven't seen that since 1970. And so that's where, while I believe inflation expectations are going to come down nicely this year, I think there's a lot of reasons to believe that. You look at the Goldman Sachs Commodity Index, it's down 30%. You look at rents, they're starting to soften. You look at M2 money supply, it spiked 45% in 2020, 2021. And what's it doing now? It's actually at a negative annualized pace not seen since the 1930s. So I have in my base case inflation coming down significantly. But I look at that PCE number, and without a recession, it's hard to see PCE move back down towards the sort of break-even 2.5 type level that we're talking about. That just gives me a little bit of pause on the margin.
Does that complicate life for those that make up a growing list of bond bulls that have spoken to me in the last month, Aaron?
I think for the first half of the year, even we will see inflation come off, and I think that it probably bodes well for continued curve inversion. It probably bodes well for the Bloomberg Aggregate Bond Index continuing to probably rally from this point forward. But it's certainly in the latter innings of trying to make it back down towards that long-term inflation level, whether it's from 7 to 5 to 3 to 2.5. I think that the last couple of innings there is going to be a great debate. I'm not sure that's going to be a debate for 23, maybe more of a debate for 24, for us to be able to see a two-handle on long-term inflation and short-term inflation expectations.
A final question, equity leadership 2023. I've had this debate all morning. Where does the equity leadership come from, and what goes into that calculation for you?
Yeah, it's really interesting, right? Price is so important, and I think we sometimes fail to think about price. So value has outperformed significantly growth this year, but at a price in certain components of value, right? You look at the financials, you look at the industrials, you look at consumer staples. They're not cheap, particularly staples. Energy remains cheap, so there are components of value, healthcare, that look still quite attractive. But then there are components of the growth, and I mean growth that has earnings attached to it, not growth at any price. And I think growth has corrected so significantly that there are some really interesting areas across mid-cap, large cap, and even to some extent mega cap growth going into the future. In a world where growth is going to be hard to come by in the years ahead relative to the last decade or two due to deceleration in population, maybe we don't have those productivity gains, we're still going to be looking for companies that can capture market share, that can develop goods and services that are in high demand and that can outpace overall GDP growth. And we think this coming year we're still going to continue to see that. So we think on both the value and growth side, both home and abroad, emerging markets look interesting, particularly outside of China, growing middle class, still significant demand for goods and services there. There's lots of opportunities. One area of concern for us remains Europe, where the industrial area of that economy we think will continue to suffer as long as that war in Ukraine continues, and the input cost of energy and electricity prices remains extraordinarily high and uncompetitive for companies in countries like Germany.
Aaron Cannon, as always, sir, thank you, buddy. It's good to catch up. About 13 minutes into this session, equities basically unchanged on the S&P. On the Nasdaq, we're down by close to 0.1%, but no real drama here. You want some drama, some theatre? Coming up, FTX founder Sam Bankman-Fried in the hot seat.
People are trying to determine how much SBF really knew. But at the end of the day, it doesn't matter. He was the CEO.
That conversation up next.
People are trying to determine how much SBF really knew. I really doubt that he's unaware of much that took place. It did grow really quickly. However, he was the CEO and maintained a really tight grip on everything that took place at both FTX and then I believe Alameda as well. So I don't think that he can plead ignorance on any of these charges.
The FTX saga continuing to unfold. Bloomberg reporting the U.S. is investigating FTX founder Sam Bankman-Fried for fraud and examining cash flows to the Bahamas. This coming ahead of the former chief's testimony on Capitol Hill. Bankman-Fried warning in a tweet he'll be limited in what he can say. Your team coverage starts right now with Bloomberg's Anne-Marie down in D.C. Matt Miller here in New York. AMH, first to you. Walk us through what this is going to look like in the next 24 hours.
Well, we're still waiting on, John, confirmation if Sam Bankman-Fried is even going to show up in person, in the flesh. We should also note he's only going to be at this moment attending the House hearing. He did not respond in time to the Senate request, but those senators in the Senate, like Senator Toomey and Sherrod Brown, they're ready to issue a subpoena if he does not show up. So potentially he's going to be virtually dialing in from the Bahamas, or he will be here in person. We don't know yet. My gut instinct is telling me this will be a Zoom meeting, but you can see from his tweet, he said he is willing to testify, but there was a caveat there. He said he doesn't really have much he can say because he doesn't have access to his data.
Well, there was a comeback from Representative Maxine Waters ahead of that, basically preempting it. She said, based on your role as CEO and your media interviews over the past few weeks, it's clear to us that the information you have thus far is sufficient for testimony. So what is this, Matt? Do we get anything new from this, or is this just the stuff from media interviews on the record to Congress?
Yeah, I don't expect we'll get anything new. I thought it was interesting how polite and kind Maxine Waters was to SBF, considering the size of the losses here. Maybe she's been a little bit nicer because this was an international business and the U.S. investors didn't necessarily lose as much, but I don't know that he's going to tell her any more than he told us. You know, Zeke Fox was down there at his penthouse just a few weeks ago trying to figure out what happened. We all watched the Andrew Ross Sorkin interview as well, a DealBook conference, and he just doesn't seem to either have answers or be willing to give answers. Maybe that's different when you're testifying under oath, but I can't imagine that it is, and I have to vote with Anne-Marie. I'm sure he's going to dial in. He'll be Zoomed to Congress. It seems like too much of a risk in terms of potential arrests if he actually comes in.
Matt, what are the answers that you want that we don't have? What are the questions that you think need to be asked that maybe haven't been asked over the last few weeks?
It just is a question of, as Reeve Collins was saying, whether he knew or he didn't know. And how could he not know if Alameda had $8 billion of margin on FTX? I mean, that seems like something you should be aware of, since he was the full owner of Alameda and he was the CEO of FTX, right? If you're giving someone $8 billion of margin, you probably want to know about that client.
You mentioned the treatment of him, the approach by Congresswoman Maxine Waters. Can you speak to that, Anne-Marie? What do you make of that, and what are people saying about it down in D.C.? Why this almost cozy approach to this individual?
Well, most would look back at the finances, which is according to Open Secrets, Sam Bankman-Fried was the second to the top when it comes to campaign dollars to the Democrats, just after George Soros. So some would say that he was, quote unquote, in bed with the Democrats, and that's why they have kind of gloves when dealing with him. But Maxine Waters, Representative Waters, she punched back on Twitter when there was a report that she would not issue a subpoena if he did not willfully come to this hearing, and she said that is not true. We will certainly issue a subpoena. But there's been a lot of criticism, and not just politicians, Jonathan, but just the media writ large, celebrities, lawmakers, business executives. You have Senator Warren also asking Jerome Powell and other banking regulators if they plan to do a review of banks that were involved in this crypto space following this collapse. There was a lot of people who were signed up and wanted to see him succeed.
Matt, what do you make of it?
Well,
you mentioned it. What's it all about?
It's It's, I think, a lot of circus, a lot of theater, and it'll be fun to watch, but I don't know that we're going to get that much out of who did what and who's responsible. The interesting thing and the important part is going to be what we get in terms of the regulatory framework going forward. Anne-Marie mentions banks. A lot of them have issued their own stable coins, for example, JP Morgan, so it'll be interesting to see if politicians want to put that ball in the Fed's court in terms of regulation and how they plan on regulating stable coins. And then it'll be interesting to see for the rest of the crypto market if they want to say, look, these are commodities and the CFTC has to deal with it, or they should be treated as securities and the SEC has to deal with it. They've already got a bill written up, so I think the regulatory side is going to be the most important to markets going forward, even if the kind of whodunit is exciting as theater.
We always frame it as a grilling, and then sometimes it's not quite a grilling. Matt, you know what I'd love? Can we stop calling him SBF? Guy's a name. And the nickname stuff. Sam Bankman-Fried, really serious issue. Let's address him by his name and stop this SBF friendly. He's not a character out of a comic. Do you know what I mean, Matt?
He's not AMH.
He's not AMH, precisely. I've just seen so much of that, Matt. This SBF, he's your kind friend who runs an exchange.
Yes.
Put your money here. It's just, no thanks.
Well, I think that happens. I mean, DSK also was accused of some pretty serious stuff, and I think maybe convicted. Nonetheless, we didn't call him Dominique Strauss-Kahn very often.
Well, I didn't call him DSK. Just my view on stuff.
But AMH may have.
AMH is great, alongside Matt Miller. To the two of you, thank you. Let's get you some sector price action. Here's Kaylee.
Well, John, we are up about 0.25% on the S&P 500. What is leading the charge today is technology, with heavyweights like Apple and Microsoft higher. Tesla, though, creating a drag on consumer discretionary. That's the big underperformer, down about 0.4%. Another group of stocks underperforming, Chinese stocks, or those ADRs here in the U.S. The Hang Seng Golden Dragon China Index down about 2.8% at the moment. You got COVID concerns and chip restrictions as well concerning there, John.
Kelly Light, thank you very much. Coming up, your trading diary, and I think you can take a guess what's in it. This is Bloomberg. 26 minutes into the session, equities up by 0.2%, call it 0.25% on the S&P, on the Nasdaq up by a little more than 0.1%. That's the price action. Here's your trading diary. US CPI coming up tomorrow morning, plus FTX founder Sam Bankman-Fried testifying to Capitol Hill. We get 9 central bank decisions this week. I'm told you get 1 on Wednesday, the Federal Reserve decision, followed by decisions from the Bank of England and the ECB on Thursday. Then another round of jobless claims that morning as well, and retail sales in America. What a week. And finally, rounding out the week with US PMIs on Friday. From New York City, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Monday, December 12th. Here are the top market stories we're following for you at this hour. Fed is yesterday's news. Mike Wilson of Morgan Stanley says the path of earnings estimates is all that matters for equities, not the Fed. And the final word from central banks. Got 11 central banks deliver policy meetings this week, closing out an historic year of tightening. We look for the best hedge. And where is it colder, London or New York City? Guy and I debate who has it worse as both places prep for severe winter and dwindling heating supplies. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. So, Guy, that's going to be a debate we're going to have over the next couple hours. But I did want to start with telling you what I did this weekend, which is I put up my tree so you can no longer call me a Grinch or Scrooge.
I wasn't calling you any of those things, of course not. I just feel like my work here is done. Alex Steele is now writing headlines about the weather. Job done.
That's it. You know, we're going to debate. I mean, I appreciate that where you are, it's very difficult to manage the weather. But still, I mean, it's really cold here.
We don't do snow. We're terrible at snow.
Fair.
As Mike McKee was just telling me, his Instagram feed is full of sort of shots of people in England crashing into each other because the weather is so bad. So yeah, no, things are a little chilly over here. But the good news is that the lights are still on, the heating is still on, we are still warm, we have sufficient gas, we're good to go. But Fatih Birol over at the IEA pouring a little bit of cold water saying, yeah, you guys are good for now, but just wait till next winter.
Yeah, no, fair enough. Also, to be fair, we're really bad with rain, so I feel like this all tracks.
Oh. We can do rain. Yeah. We have lots of words for rain. We are like the Eskimos of rain. The Eskimos, lots of words apparently for snow. The Inuit, we have lots of words for rain.
I don't know where to go from here.
What we do.
I don't know where to go.
We do rain. Okay, let's talk about what we should really be talking about, and that is the week that is coming up. You just highlighted some of what is going to be coming up. We're obviously going to be watching the big central banks. We're going to be watching what is happening with the CPI numbers. Our CPI numbers come out before your CPI numbers. Ours come out tomorrow, but nobody's talking about that. Nobody cares about UK CPI. Maybe the Bank of England, but who knows? And then we're going to be moving on, obviously, to the Fed, ECB, Bank of England, come Thursday. The good news is, Alex, that we now know that inflation is coming down. We know this because Janet Yellen, who is the former Fed chair, now Treasury Secretary, her signature is literally going to be on the money, and as a result of which, she knows what's going on, apparently. And she says, and she was talking to the press over the weekend, that inflation is coming down.
So I believe inflation will be lower. I am very hopeful that the labor market will remain quite healthy so that people can feel good about their finances and their personal economic situation.
That takes us to our question of the day. It is kind of alluding to what Mike Wilson was saying, Costin was saying, i.e., don't worry about what's going on with the Fed this week. Don't worry about what's going on with CPI this week, because basically the story now is going to be all about earnings. Now that, I think, Alex, only really applies to the equity market, obviously. But Mike McKee is going to be taking the Fed very seriously this week. Mike McKee is going to be taking CPI very seriously this week. But there are others that disagree. And Jess Menton is here to kind of put that point across. They both join us from Washington and New York. Mike, I'm going to start with you. Janet Yellen says CPI is coming lower, so we don't need to worry about inflation, the print this week. And we don't really need to worry about the Fed because, to be honest, we know it's going to give us 50 basis points in terms of the hike. And then it's going to give us an economic forecast and a summary of economic projections and dots, etc., which we know are going to be wrong because, let's be honest, they're economic forecasts. So, yeah, maybe we don't need to worry about either of these things. Your thoughts?
Well, I think the only reason you would worry about CPI is if it came with some sort of very big high side surprise, because then that would change the Fed's calculation going forward, and then that has an effect on earnings. But I wouldn't disagree with Mike Wilson. I think that the Fed doesn't matter in terms of what they're doing on Wednesday so much as the new dot plot and the new economic forecast, because if the Fed starts to forecast recession ahead, and remember the last meeting minutes showed that the Fed staff thought there was a 50-50 chance of recession, well, then that's going to have an effect on what analysts are writing down for earnings estimates. And the same thing is true if they see the Fed having to raise rates farther. So I think there is a portion of this meeting that's going to matter to Wall Street, but the actual decision isn't going to be as important.
Mike, you disappoint me. I thought I'd get you all riled up with that. This is a disappointment on this Monday. But Jess, nevertheless, let's pretend that Mike was really offended by the Fed's yesterday's news. But I think the point is, are equities already pricing in some kind of a recession, or do they have to do that even more, which then obviously will wind up hurting earnings estimates?
Right. When I've been talking with money managers, a lot of them are assuming that the U.S. economy will go through at least some sort of soft situation as far as a recession is concerned. But the big question mark is just how severe, either if there is potential of a soft landing or if the U.S. economy is not in, say, a severe recession, what that means as far as positioning if you're a money manager. And especially because a lot of the beaten down corners of the market this year, obviously technology and growth stock, discretionary, they're looking to see if there's any sort of mean reversion type play that could potentially be happening there. But again, when you're looking at Mike Wilson, that's also echoing what David Costin over at Goldman Sachs has been saying. And they're really thinking that the S&P 500 will pretty much go nowhere over the next year and ending similar to where it is right now a year from now. But you have other analysts like Ari Wald over at Oppenheimer that is singing a bit of a different tune. And he's warning that if you're waiting for earnings to bottom, which when you're looking at some of these
big banks, they're warning that next year that's the big token as far as what the big risk is. But he's warning that if you're waiting for earnings to bottom, that's a poor timing signal because potentially you would be buying 6 to 7 months later after the market bottoms. So not everybody is singing the same tune as some of these big Wall Street banks.
Jess, though, do you believe that Wall Street believes the Fed? Because my kind of instinct over the last few weeks has been increasingly that Wall Street doesn't believe the Fed, and maybe with good reason. The Fed gave us transitory. The Fed's now playing catch-up. The Fed is really struggling to predict when rates are going to peak. Why should we believe the Fed, other than the fact we're going to get 50 basis points from them this week? If they don't give us that, then that would be a surprise. But everything else must be taken with a pinch of salt.
You are seeing a disconnect between how the futures market is pricing this versus how economists are thinking the trajectory of this is happening. So if you look at the future swaps for next year, you're looking at potentially a terminal rate around 5% in the middle of next year, and then potentially cuts happening. Whereas when you look at the latest Bloomberg survey of economists, they're thinking that the Federal Reserve could get around 5% terminal rate, but then stay there all next year. And so that's still the big question as far as where exactly is the trajectory of that happening. And again, we will get the dot plots at this meeting and the quarterly projection. So that will give us an update on where Fed officials see trajectory of rates happening, not only in 2023, but obviously in the years after that, as far as where exactly potentially the Federal Reserve is seeing where we could see that potential rate cuts happening. So that's going to be really scrutinized at 2 p.m. Eastern on Wednesday. And then obviously we will hear from Fed Chair Jerome Powell 30 minutes after that.
So Mike, where will the surprise be? Where will the Fed become today's news and surprise, in whether it's CPI or the Fed or the statement or Powell?
I think you would look to Jay Powell for some kind of surprise. It seems like in his regular news conferences, there's always something that stands out for investors that makes them think a little bit differently. The SEP, the Summary of Economic Projections, and the dot plot are going to be important, as Jess says, particularly the transition from 2023 to 2024, because the Fed is likely to say we'll keep rates high throughout 2023. They're still trying to convince the markets of that. But then how fast do they go down in 2024? And what's the spread between the terminal rate at the end of 2023 and the end of 2024? How fast would they come down? They'll give investors a framework to start to try to think about. I do have to throw in one thought here, and that gets back to what Guy and Jess were saying about the economists and the Fed's forecasts. Let's just go back and look last year at this time at the market forecast for the Dow and the S&P, and I don't think anybody has really been on track.
Ooh, throwing shade.
That's probably a fair criticism, but probably less fun. Mike, one final question. Are we going to get a Wall Street Journal article? Are we going to find out before we find out whether or not the Fed's going to do any surprises? If by Wednesday morning there isn't a journal article, are we good to go?
Yes, you'll be good to go. And I don't think you'll get a journal article this time. There was some sort of hints in the journal's piece looking ahead to this meeting where Jay Powell was quoted as saying he hasn't changed his mind about the long-term terminal rate staying high for longer. And I think that's the message that the Fed wants to send. I think the other thing to watch for is in a wide shot, Guy, of the press conference, when you're looking down at all the reporters, you're going to see an awful lot of World Cup game going on their individual computers. Yeah. And if you want shade, that's
we're not talking about the World Cup. We are not talking about the World Cup.
Yeah, tough
We're done
stuff.
with that.
Tough stuff, Guy. Tough stuff. But good point, Mike. All right, guys, thanks a lot. Really appreciate it. I just mentioned and Michael McKee. Thank you both very much. Well, coming up, that was my bad. Coming up, we're going to be talking to Julie Beal, portfolio manager at Kayne Anderson Rudnick. She's going to weigh in on our question of the day: is the Fed's yesterday's news? This is Bloomberg.
It's a big week for the U.S. economy, and Bloomberg's got you covered.
My head's spinning here.
First, tomorrow morning, CPI data comes in.
We're seeing things work themselves out.
This is going to be a really choppy ride.
Then on Wednesday afternoon, a special surveillance will cover the Fed's last rate decision of the year.
Power of that Fed speak is declining.
Does this Federal Reserve have the commitment to keep going?
The question is, how high do they have to go?
The CPI report tomorrow morning and the Fed decision Wednesday afternoon. Right here on Bloomberg, your global business authority.
If we can kind of get all these cuts out of the way by March, it's still reasonable based on the historical playbook for October to be the low. Now, that doesn't mean we're not going to turn around, but I don't necessarily think that we have to break to a new low because of this earnings issue.
That was Lori Calvasine of RBC Capital weighing in with her response to Morgan Stanley's Mike Wilson on the end of the bear market, which leads us to the question of the day. Is the Fed yesterday's news? Joining us now, Julie Biel, a portfolio manager at Kayne Anderson Rudnick. What do you think? Old news?
Well, I mean, the problem for the Fed is that they're using the news of last month in order to make their decisions. So it's tough for them to really be ahead of the curve when they are completely data dependent. And they should be, right? They weren't enough data dependent in the past, and that's why we got this whole transitory mess. But I think going forward, what really matters for the markets, more so than the Fed, because I think it's pretty well telegraphed that they're going to stay higher for longer, is when we're going to get this cut in earnings estimates so that we can kind of reach full capitulation. I mean, all of us know that we need to be cutting earnings estimates. I mean, literally, my preschool teacher has asked me, when are analysts going to turn down their estimates for 2023? It is the most transcribed thing we can think of. So I think that's actually more important. And so I kind of agree with this point of view. We can say the dot plot is relevant, but when has the dot plot been right?
Are you basically saying that the analyst community's got its fingers in its ears, collective ears, and is going la, 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 la? When do they stop doing that?
I think the problem is that, you know, analysts are entirely dependent on guidance. And so until companies are willing to start kitchen sinking some of their guidance, we're not going to really see analysts stick their neck out and say, you know, I'm predicting a major slowdown. And it makes sense, right? You kind of don't want to stick, there's not a lot of incentive for them to do that, but it kind of has to happen. We all know that, you know, right now, stocks look expensive still, and they probably will get even more so when earnings estimates decline.
So, Julie, my issue there is that I feel like I've been hearing this for 6 months. What's your level of confidence that it actually happens?
Well, I mean, I think you're starting to see companies talk about the hesitation that they have to do more business investment, right? We know that consumer confidence has been bouncing around a lot. I would argue that it's probably getting a little boost from the lower gas prices right now. And so holiday may be okay, but not great. And then looking forward into 2023, there's not a lot to be that enthusiastic about. And so my thought is that I think the weaker consumer confidence leads to weaker business confidence, and that leads to lower investment, the decisions to start trimming employment, particularly on things that we got very bulked up on, so things in marketing and technology spend. I think those are going to get soft, and that's going to cascade through the economy.
Okay, so let's just talk about that in a little bit more detail. Which areas of the market are most vulnerable to earnings downgrades, do you think, Julie?
I think for sure you can see weakness in consumer discretionary. That's a place that, you know, we don't want a ton of exposure to. I actually worry a lot about enterprise software. You know, all of these businesses have transitioned into the cloud, and most of these businesses thought to themselves there's going to be a lower total cost of ownership. And I don't think that's borne out to be true. And so you can see a lot of businesses deciding to pull back on their IT spending with some of these cloud service providers as a way to conserve cash. And I don't think that's in software estimates at all.
So where is this scenario priced in? Many are looking at small caps. Again, I have a hard time thinking that if we're going to kitchen sink it, small caps are the place to be, but that's where a lot of people think everything's already priced.
Yeah, I mean, for sure, if you look at the dispersion between small and large cap, small caps have really, really taken it on the chin, and they are more economically sensitive, but typically they're also more nimble and able to adjust quickly. So during the pandemic, we saw small business be the first to kind of trim back expenses, preserve their profitability, and get through that period. So I think they will be the first to show the effects of any economic softness, but there are businesses within, you know, small and mid cap that have a lot of control control over their markets. I think of a company, in software, Tyler Technologies, that serves municipal governments. I think those municipal governments will continue to spend. They have the funds from stimulus to do so.
So Julie, what does the Julie Biel playbook for 2023 look like? What have you written down?
Our playbook, it really doesn't change very much, right? Because we're long-term investors. We don't try to predict the macro. I mean, I've tried to predict the macro on here, but I mean, how capable am I? Not really, right? So what we don't do is we do that. We just focus on quality businesses. And so I am very focused right now in a rising rate environment on making sure that I don't have companies with a lot of leverage, because I just think that's going to sting quite a bit if we stay higher for longer.
That's longer term. Real quick, Julie, before we let you go, where do you think the asymmetric risk is in the market over the next 48 hours?
I think people are probably assuming that there's going to be a pretty normalized print in terms of CPI. I think people are expecting that to get softer, particularly with gas prices and used car. And so I think there's a negative surprise that could be in there.
Julie, have a great week. Have a great holiday. Thank you very much indeed, as ever. We always appreciate it. Julie Biel, O'Kane, Anderson, Rudnick, thank you very much indeed. Still ahead, shares of software company Coupa soar after Thoma Bravo's $6 billion takeover deal. We've just been talking about this space. More next. This is Bloomberg.
It's time for the Bloomberg Business Flash. Just a look at some of the biggest business stories in the news right now. I'm Ritika Gupta. It's Amgen's biggest acquisition ever. The biotech giant has agreed to buy Horizon Therapeutics for $27.8 billion. That represents a 48% premium since the developer of autoimmune disease treatments disclosed it was in talks with 3 potential buyers. Both Sanofi and Johnson & Johnson unit dropped out of the running. Bloomberg learned that Saudi Aramco has started talks with potential backers for its $110 billion gas development. The state-controlled company is seeking equity investors that could help fund the development of midstream and downstream projects. The gas project is key to Aramco's strategy to diversify energy exports. The investment bank Evercore is advising Aramco. And private equity firm Thoma Bravo has agreed to buy Coupa Software for an equity value of $6.2 billion. That represents a 77% premium to the California-based company's closing price on November the 22nd, prior to a Bloomberg News report on its potential sale. Thoma Bravo outbid Vista Equity Partners for Coupa. And that is your latest Business Flash. Alex.
Thanks so much, Ritika. It is 22 minutes past 7 on the West Coast. Let's get to the startup. We cover the tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now is Bloomberg Technology co-anchor Ed Ludlow. Ed, good to see you. Happy Monday. What's everyone talking about?
Yeah, I mean, this deal is astonishing. 77% premium over the closing price in the session that Bloomberg first reported that this company was in talks. I don't know about you guys, it's a really interesting one. Why? Why do this, Thoma Bravo? Why acquire them? The playbook from the company in the past has been to take a name like this and merge them with a portfolio company, or if you look at Cooper's full year fiscal 22 financials, they had negative adjusted EBITDA of $83 million. Then I'm thinking, well, what? The premium doesn't make sense. But a lot of that is because of marketing spend. How do you whip this company in shape? And yeah, I mean, if you're a shareholder of Cooper, great.
I guess every roll-up has to start with a single company, Ed. And you talk about that premium. There was talk that this number could be significantly higher. Have they got a good deal here?
Yeah, it's interesting. I think there was a note out from Citi that the $81 per share that Thoma Bravo will pay in cash is actually lower than some shareholders wanted. Although that said, if you were a shareholder in this situation, Guy, you obviously would, I guess, you would want more. These SaaS companies are really interesting. Cooper's one where you basically manage your business expenses, your goods and services spend. They have kind of very visible recurring revenues, and when they disclose some of their earnings as part of announcing the transaction this morning, third quarter revenue came in slightly above expectations, but it's still only at $217 million of revenue. Third quarter adjusted earnings per share 15 cents above the estimate, which was 10 cents. It's just the numbers here are so big. And I go back to that question, what are Thoma Bravo going to do with it?
Yeah, and weren't they the ones that were going to spend $1 billion anyway in tech? I mean, now we kind of know that they're starting, so there is that. Hey, before I let you go, so I wanted to know what you made of Rivian. That stock down 3%. They're pausing their plan to make vans with Mercedes in Europe. What gives?
Yeah, well, it was fun being up in the middle of the night having to deal with this one. Look at the story on the Bloomberg. It's got my byline on it. Rivian bit off more than it can chew. It had this bloated balance sheet where all the cash is essentially committed to build a plant in Georgia and start production on its next generation mass market vehicle in 2026. The agreement with Mercedes, which was only announced in September, was to invest and jointly operate a plant with them in Europe. So that would give them entry to Europe. And my understanding is that they looked at the numbers and were like, actually, this isn't such a good idea for us. We have the balance sheet to go it alone here in the US first, focus on what we're doing, which is an electric pickup and SUV and the vans for Amazon, and the Europe stuff can come later. So they're walking away.
I just want to check what the Tesla is, the Tesla share price is over the last few days. We're down pretty aggressively again this morning. Ed, Tesla's all over the place. Why?
Yeah, I don't know the answer why. All I can do is kind of recount the reporting, which is Bloomberg's reported both that in Shanghai production has been pulled back. They've cut the number of hours in the shifts in that plant and stopped onboarding new workers. That raised concerns about the demand picture in China. On the other hand, Bloomberg also reported that it's just later going to shut down the assembly lines for standard annual maintenance, which is something they do. So I think investors want to know from Tesla what's going on.
It's down 5% over 5 days, down by 4% today. Let's call it that, circa 4%. Great stuff, Ed. Love the time. Thank you very much indeed. Ed Ludlow joining us from San Francisco. We're going to talk energy next. This is Bloomberg.
about an hour into U.S. trading session on its Monday. Happy Monday, guys. Bloomberg's Katie Greifeld is tracking these moves. I got to say, volume pretty much non-existent.
Yeah, we're seeing some calm before the storm. Of course, we have a big week coming up, starting off with CPI tomorrow. We get the Fed decision Wednesday, and then we get a whole bunch of other central bank moves as well. If you look at the price action to start, the S&P 500, it's up about 0.3%, nothing to write home about. The NASDAQ 100, I'm going to call that unchanged. You look at what 2-year Treasury yields are doing, I'm going to call that unchanged as well. Copper, you are seeing a little bit of movement there to the downside. Copper down about 2%. So NASDAQ 100, let's go back to that. Like I said, it's unchanged. But what's interesting is if you actually look at how many days it's been trading under its 200-day moving average, it's the most number of consecutive days, 173 to be exact, since the tech bubble burst about 20 years ago. So whether we get another positive catalyst for this index this week, those big tech-heavy names, remains to be seen, but it is a big one. But another big story today, even though you aren't seeing much price action at the index level, is the nearly $70 billion worth of deals that was announced today. I'm going to call it M&A Monday. I'm sure you guys have heard that one before. You have Microsoft to buy 4% of the London Stock Exchange. That is boosting Microsoft shares a little bit. Thoma Bravo is buying Coupa. That is absolutely sending shares higher, about 27%. You go down the list, you have Amgen, Horizon, and then Meridian Bioscience also coming out and giving the anticipated closing date for its own merger. So a lot of names to keep track of, and you are seeing some movement in the individual stocks, even though the indexes are a little sleepy today.
Yeah, but it's going to be a busy week. We just yet to get going. Katie, thank you very much indeed. Katie giving us a sneak preview of the chart that I'm going to show you next. I want to talk about the weather. I want to talk about power prices and the weather, about what's happening here in Europe right now. So this is 1 day ahead power prices in the UK. Now this, as we go into the renewables world, Eddie van der Vold pointing this out on the Markets Live blog on the Bloomberg, we are going to see significant volatility. But what we saw yesterday was huge volatility. We're trading 518. We got up to around 2,600 yesterday before coming sharply down. The concern was tonight. So there's expected to be some real stress on the UK grid tonight. It's going to get very cold. There's all kinds of other factors coming into play here. There's not going to be very much wind. There was an expectation potentially we're going to have to fire up the coal generating capacity. That now doesn't look like it's going to be the case. But this is a kind of indication of the stresses and strains that Europe is going to be going through this winter. This is the first real test. And this is the weather map across Europe right now. You've got real cold weather gripping parts of the UK. We've seen snow in London overnight. Germany, France, Switzerland, across the Alps, incredibly cold up into the mountains in Germany, incredibly cold right now. And this is the first real test. And Europe is seeing below seasonal norms in terms of the temperatures at the moment, and it is putting pressure on the grid. The key thing at the moment, though, is that the grids are holding up, and I think that's the critical thing. And these spikes we're seeing in the power prices, Alex, actually aren't a very good indicator as to whether or not the grid is going to fail because of what is happening with the weather. But I think, as I was saying at the top of the show, my work here is done. So when Alex and I started anchoring together, the weather was not a subject of discussion. It is now a big subject of discussion. I feel I've converted you into becoming something of a weather nerd.
It's sort of all you talk about. B, it's also winter and cold. And C, I knew he was going to want to talk about the weather and how cold it was. So on Saturday, I looked it up on my phone to see the weather differential between the two cities. And I have to say, with wind chill, it was only 4 degrees warmer here in New York City. I'm just saying, like, we're getting it too. And to this point, Guy, this is a picture of my home in the Berkshires in Massachusetts and what it's dealing with after the last 24 hours. I understand there's a plow, but that is some serious, serious snow happening.
But you're not there, are you? You're tucked up warm and nice and cozy in New York City, which I hear is quite warm.
But no, it's not warm, it's freezing. But to this point, there was a memo going out to my condo being like our increase in heating bills is going to be up 50% this year. Everyone's starting to freak out. So like we're getting it too. The Northeast is not in a good spot necessarily when it comes to heating either. Anyway.
Anything you can do, I can do better.
Ain't that the truth? Okay. I'll give this the question of the day on a Europe census. Can Europe weather this storm? We want to bring this question to Tina van der Straeten, Belgium's energy minister. She joins us from Brussels. Minister, thank you so much for joining us. Obviously, this is an impassioned debate between Guy and myself. How prepared is Europe for this winter and for next winter?
We are in Europe. We are prepared. We have been working on this already quite a few months. And for example, as you were discussing, if we are prepared for the electricity and if our grid is prepared for electricity, Belgium is a very small country within Europe, but at an energy crossroads, we are interconnected to all of our neighbors. And already this summer, I asked to all the electricity producers in Belgium to be ready for winter, to see if they could postpone maintenances planned in winter, so that we stand ready to help our neighbors if necessary.
Minister, Ursula von der Leyen was speaking a little earlier alongside Fatih Birol, the IEA's chief, and they were talking about the fact that 2022 is going to be difficult, but 2023 is going to be even more difficult. The reason it's going to be more difficult is we are going to struggle to fill the storage without Russian gas. Is this year going to be difficult? Is next year going to be significantly harder, do you think?
Yeah. With the war in the Ukraine, nothing is going to be easy anymore, not for this winter and not for the winter thereafter. But if we look at the winter that is now beginning, and I saw the pictures of the snow already also in Berlin and in Brussels, we had a little bit of snow already. We managed through this winter because we have prepared it. We have filled our storages, we have decreased our demand, and yes, there is another winter coming, and preparation of the next winter is also being done now. Like, for example, joint purchasing of gas is something that will be discussed tomorrow at the Energy Council. It will be difficult if we are not taking things into our hands. And what is for sure is that we have proven that we can take policy decisions at record time, for example, with regard to storage obligations, but also with regard to demand reduction, and then we can manage.
Well, to that point, and we'll get to the meeting in just a moment, but is there appropriate incentive for demand destruction? If subsidies continue, households won't be reducing their consumption.
I do not totally agree, because what we are looking at, for example, with subsidies is the subsidy to help our households, but also with regard to discussions on intervention at wholesale prices. It's to address excessive prices, and this is excessive episodes that we don't want to see to happen again. But even if prices are lower, they are still significantly higher than it was when I became a minister in August 2020. The gas price was 15 euros. And even at the price of 120, 130, 140, this will be a very high price. And if one would say that there won't be any price signal anymore for households or for industries to reduce demand, then I don't think that they are not in line or what people can afford to pay.
You, Belgium, are amongst a number of countries, Italy, Slovenia, Poland, amongst them as well, that are pushing for a significantly lower number when it comes to the gas price cap that continues to be discussed within the EU, so far with little success. Minister, how do you respond to those that say, okay, you want to lower the price cap, we're not going to get the gas we need, that there is going to be a supply problem if we push the cap too low?
These are safeguards, important safeguards that are also important to us. This is with regard to security of supply. It's not a yes or no situation. It's not a binary one. Security of supply is important to the continent as a whole. We have to keep gas flowing to Europe. So that means that if we have an intervention, that it should be linked to the world markets. So I think between all 27 member states, this is a common understanding that we won't take any risk with this security of supply. And I won't agree, if you allow me, that we didn't have any success so far. Even a few months ago, this was not even in the Council conclusions, this was not even in the text. And what we have now is a concrete proposal on the table, a proposal made by the European Commission that will be discussed tomorrow. So we are not there yet. I agree, there is no consensus at this moment on how it needs to work and on the numbers, and probably this will even move between now and tomorrow and even after the meeting of the heads of state. But we have come a long way, and we are working on something that is workable in reality.
Minister, it's fine. You can disagree with Guy. I do it all the time. But to that point,
perfect.
If it is moving along, what would be a win for you tomorrow then? Clearly, like a full-on gas cap deal wouldn't happen. So what would be a win for you?
A win is, and it's a win for me, but it's a win that is a win for every member state of the European Union, is to give security, a sense of security to our households and to our industries. Everyone is suffering under this huge energy crisis and these high energy prices. And we have already a regulation in place with regard to demand reduction. We are working on the fast permitting to have this acceleration of the green transition, these renewable energy sources to come. And now we have to control these gas prices too. And so it has to be something in place that makes sure that these high excessive prices, the episodes we have seen during summer, that this won't happen anymore.
Minister, I hear what you're saying about permitting. I was talking to the Vestas CEO the other day. He is still incredibly frustrated that it takes so long to get a permit to build either offshore or onshore. You talk about the fact that we need to accelerate the green transition. The technology is largely there. The technology we need probably already exists to do the bulk of the heavy lifting. But it's the politics, it's the not in my backyard that is getting in the way right now.
Yes, I do agree with you now. And his frustration is also mine. If we don't manage to solve this permitting issue, then we won't accelerate the energy transition. And that is specifically what the other text on the table is about, how to fast-track permitting, how to define specific areas where we can have go-to zones for development of renewable energy, both onshore and offshore. And for example, with regard to offshore, we have been with some European countries like Germany, also Denmark, the Netherlands and Belgium, to have this Esbjerg declaration and to bring our ambitions together to develop far more offshore wind. And we are putting also legislation in place so that Vestas and also others can continue to build, because they can build in record time. They can build in only 2 years' time. And it's the permitting that consumes time, and that we have to work on.
One more quick before we go. U.S. scientists made a breakthrough that was reported over the weekend in nuclear fusion energy, which obviously would be enormous because that would really help the whole clean energy debate. Is that in your playbook at all over the next few decades?
Specifically in Belgium, we have allocated research money to these small modular nuclear reactors, and we even had a working session last week with Belgian research institutions and American ones to see how we can work together to have this moving. It is in our playbook if it doesn't come with the disadvantages of the nuclear industry. So that means that we have to manage waste. Waste is hugely costly and also very dangerous. But if we can design a small reactor that has a minimization of waste but also is secure from a passive point of view, if it's also flexible, then it is in my playbook. But the nuclear industry comes with big advantages. If these big disadvantages, if we can work on these disadvantages, then it is in my playbook.
Minister, a great pleasure. Thank you for answering all of our questions. Belgium's Energy Minister, Tina van der Straeten, joining us from Brussels. Nuclear fusion, no waste. That's one of the big upsides. Okay, coming up, China faces massive hospital lines, medicine shortages, is basically at this point almost overwhelmed. Health hotlines certainly are overwhelmed. This as it pivots aggressively away from zero COVID policy. Rasmus Beck Hansen, co-founder and CEO of the health analytics company Airfinity, joining us next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. Bloomberg's learned that Japan and the Netherlands have agreed in principle to join the US in tightening chip-making machinery exports to China. That is potentially debilitating blow to Beijing's technology ambitions. The two countries are likely to announce soon that they'll adopt at least some of the measures the US rolled out in October. Meanwhile, COVID is rapidly spreading through Chinese households and offices after the country's pandemic rules were eased. That's led to turmoil in poorly prepared hospitals. Some facilities are struggling to find enough staff and others are suspending non-COVID treatments. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg, guys.
Ritika, thank you very much indeed. Let's get more on China's reopening and the struggles that it's experiencing with it. Rasmus Bech Hansen, co-founder and CEO of Airfinity, joins us now. Airfinity, a health analytics data company. What do you think the picture really is in China right now? The official data is showing us one thing. What do you think the unofficial data would look like if we could see it?
Yeah, you're right, Guy. You know, it is very hard to make sense of the official numbers coming out of China because what they show is really a decline in case numbers from last week. And already last week, they were at a fairly low number, around 30, I believe, per million. And then should have dropped to like 15 per million, right? In comparison, US is almost at around 200 per million, right? So we're seeing the official numbers, this kind of quite dramatic drop at the same time as vaccination is easing. At the same time, we know that Omicron is very transmissible and hitting across China. And then anecdotally, we are seeing reports on hospital overflow. We are seeing a medical supply shortage in the Beijing area. So these are two very different worlds. I think if you look at our forecast, we would have expected around 1,000 per million cases by now, and that is equivalent of more than 1 million cases. So I think definitely the truth is somewhere in between that number and then the official number from China. I find it very hard to see why cases would have dropped over the last week.
So the case surge that we keep hearing about, though, seems confusing because based on Bloomberg reporting, it seems like people that have a mild version of COVID will go to the hospital because of the fear instilled by the government during its zero COVID policy versus those that desperately need to get to the hospital. Can you give me perspective on how many hospital beds might be taken up by severe cases?
Yeah, so I think that is a really good point. Like when you look at hospitalization numbers, you have to distinguish between ICU capacity, ICU numbers, and then hospitalization numbers, and then deaths. Those are the three kind of key metrics we've also monitored across other countries. But none of those numbers, if you look at the official stats from China right now, look very worrying. We're not seeing an increase in any of those. I think that the biggest problem China has is that their ICU capacity is quite low. It's around 3 per million. In comparison, Hong Kong had double that. So China is not particularly well prepared from an ICU. I think people going to the hospital with a mild disease is not the biggest concern, but it is the ICU starts to overflow, seeing problems with ventilators and all of that we've seen in Western countries and elsewhere over the term of the pandemic. If that starts to happen, China is a problem. But the official numbers are not showing that at the moment.
How useful is the Western experience here? We don't have the vaccinations. Even in the West, we had stop-start. Is that what we're going to see here, but maybe worse?
Yeah, I think that is the only way forward. I think like last time we spoke about that the only route forward for China really is to massively increase vaccinations, and we have seen a 6-fold increase in vaccinations over the last week. So I think that's quite positive. We've also seen that China has approved 4 new vaccines, a protein subunit. They're still homegrown vaccines, but they are new generation of vaccine technology. They are targeted the Omicron, and the initial data from the studies around them show that they're better than the original Chinese vaccine. So we're seeing an increase in that, but still in comparison, at its height, China vaccinated 22 million a day. Right now they are vaccinating around 600,000. So there's still a wide gap and still much more that China can do to boost vaccinations.
And this is just the original vax, right? This isn't like a booster or anything like that. I mean, I'm on like my 5th or 6th shot or something crazy, right?
Yeah, it's a combination. It's both there's a lot of people in China who haven't had any vaccines at all, but there's also a lot that haven't had any boosters, right? So it's both. And I think the new generation of vaccines that was approved this last week in China, those are mostly for boosters. So booster shots that work okay in combination with the original vaccines. It's also interesting, by the way, that the mRNA vaccine that's produced by Pfizer and BioNTech with Fosun is actually being used in Beijing at the moment, but only for foreigners. So one would wonder, could that be expanded to a broader part of the Chinese population?
So given all of this, where do we think the peak in this current cycle is going to be? How big a number are we talking about?
Yeah, so I think, if we look at Hong Kong and others, it can go much, much higher. Hong Kong, as its height, was around 8,000 per million, right? And as I said, China is now much, much lower. To go much higher, and from previous peaks, that would happen 1 to 2 months in. So that would be mid-January, end of January, early February. We would see that peak, and then sadly at that point we would see more than 50,000 deaths a day, if based on the experience from other countries. So those are kind of the real numbers we're looking at. And I think, as said, I think we're not there yet. I think we would have seen some different picture in China if that was the case. But I also think that we are not on the very low numbers that the official stats are reporting.
Yikes. Okay, big numbers there. Rasmus, we always appreciate it. Rasmus Beck-Hansen, co-founder and CEO of Airfinity. This is Bloomberg.
Around 34 minutes to the European close. Let's start the countdown, figure out what is happening here. European stocks down by around 0.5%. Most sectors are in negative territory. Bottom end, you've got the basic resources, the miners. Interestingly enough, at the top end, you've got the energy sector. So a real divergence in the commodity space right now. 436 volume is a little light. It's going to be a big week, but Monday is definitely not a big day. UK nat gas, interestingly lower. Despite the cold weather, there is a lot of LNG coming into the country right now. Worth bearing in mind. The pound, absolutely flat. GDP data today, probably not enough to change the Bank of England's sort of trajectory. Elizabeth Martins is going to join us from HSBC next. It is Monday, the 12th of December. European equities are lower. They're off their lows. You've got energy and basic resources at either end of the spectrum. But to be honest, this isn't the map you want to be looking at. This is the map you want to be looking at. It's all about how cold it is in Europe and what is happening with the energy crisis. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
European markets look a little bit like this. Equities are down. We're down by around 0.5%. We're trading 436. Commodities are bracketing it, but the bulk of sectors are in negative territory. Energy is the only one that is in positive territory. Euro dollar's a little off right now. I think basically everybody's waiting for Tuesday, Wednesday, Thursday. Those are the big days. CPI, Fed, Bank of England, ECB. There's plenty of other central banks to throw into the mix as well. Just a little bit of softness, 105.20. Nothing to get too excited about. I'll tell you what, though, you want to pay attention to what is happening in the UK retail space. We are starting to see a significant ramp up in companies going into insolvency. ASOS is not one of those yet. It is down by 6.84%. It is looking at maybe switching up its finance team, we understand, to include restructuring specialists so that it can survive and weather the storm. Others are not doing as well right now, but nevertheless, the pressure on UK retail absolutely on right now.
Yeah, 100%. Here in the U.S., it's a similar macro backdrop. So the S&P is up by 0.3%. The NASDAQ 100 just recently flipped into negative territory, but you're not seeing a ton of volume into the central bank decisions and the CPI over the next few days. Energy also outperforming, up 2% almost. WTI outperforming Brent, partly because that Keystone pipeline is still not operational. We don't have any details yet as to when that's going to kick back up. The leak has been stopped, but we don't know when it's going to actually restart. Even yields pretty much go nowhere. 434 is where we sit. This is an active trading week, but the question becomes, like, where is the asymmetrical risk going into central bank meetings? Is it who's going to be more hawkish? Where do you see that reflected? Those seem to be the questions. How do you deal with options, etc.?
Absolutely. And then you've got to roll in the weather, Alex. I joke, but basically I think this is the scenario right now. You've got an economic forecast, you then need to times it by a weather forecast, and the result of that is, well, who knows? And I think that's the problem right now, is that actually predicting all of this stuff I think is incredibly difficult. You guys are about to see a big storm on the West Coast. The weather is clearly getting colder. There's a lot to think about. I wouldn't want to be an economist trying to figure out what the net result of all of this is.
No, if you're an economist, you're also now a weather forecaster. No one wants that job. But even here in the Northeast, we are used to snow and we're used to cold, but it's the pricing, electricity pricing and heating bills that we're not used to. My building talking about them going up 50%. We're talking about different ways to conserve energy. So it still has to be a supply issue, but now it really has to be a consumer issue. We just have to use less. We have to wear more sweaters. I jest, but I'm not really.
No. Alex has been predicting that would be my future for a while. I now am in some way glad to hear that it is becoming yours as well. But here's the challenge. All of these governments, Alex, and we were talking to the Belgian energy minister about this a few minutes ago, all of these governments have set up for one winter. They have set up to spend over one winter. All of the support lasts for one winter, maybe a little bit more, but not much longer. And this is the real problem, is because actually this may not be a one winter phenomenon. And that was the point that was being made a little earlier by the IEA director, Fatih Birol.
This winter, it looks like we are off the hook. We may go through this winter with some economic and social bruises, but the message that I am bringing up to you today is that the crisis is not over. And next year may well be, 2023, may well be much more difficult than this year.
Well, let's talk about it. Let's talk about it more. Our question of the day in this hour is basically, can Europe weather the storm? The IEA director suggesting maybe this winter, yes, but who knows? about next winter. Let's kick it around a little bit. Eddie van der Volt joins us from Markets Live. Todd Gillespie joins us from our energy team. Todd, I'm going to start with you. The concern is that this is going to be a multi-year phenomenon, but I guess the real challenge is going to be managing the volatility. Yes, this is going to last for a while, but we can get used to it if it lasts a while. The issue is going to be the peaks and troughs and how big the amplitude looks like in between. What are people saying about that? How big a swing are we going to see between a cold day and a less cold day? A day when we have to fire up the coal and a day we don't have to fire up the coal. This weekend I saw UK electricity prices absolutely all over the shop.
Yeah, I mean, there's a big difference now between what we call in the intraday market and the day-ahead market versus longer down the curve. So we're actually seeing a very odd day in the UK market today where we're having a big flow of LNG. So gas prices down the curve are actually dropping quite significantly, but intraday prices today have actually hit records, all-time records. And we're actually seeing something happening quite aggressively in the balancing market today, where we are seeing gas plants being paid by the grid operator to come on at record high prices, £5,500 per megawatt hour. That's about 100 times what you would normally expect before the energy crisis. So there's a lot of volatility, you're right, and a lot of these costs are going to be passed on to consumers in one way or another. But looking down the curve, looking longer into the future, everyone's quite concerned about filling gas storage next year, given that we won't have as much Russian supply as we did this year, which helped to fill up our gas storage in time for winter. We're leaning quite heavily on that now, but withdrawal rates are slower than they were in previous winters, which indicates that we have learnt somewhat to reduce demand, and maybe we can learn from those patterns going forward.
Hey, Eddie, we were just talking about how economists have to be weather forecasters. Do commodity traders now all have to be power traders at the end of the day? I mean, this is a tiny market that's now becoming with huge ripple implications.
Right, absolutely. It's a bit like a couple of years ago we all started becoming epidemiologists, and I think that's the case here. A lot of people are suddenly grid experts, right? I think there's one big thing that we're seeing. As Guy said, we're seeing the first big test for European power consumption, where we see cold weather. But I think the market is telling us that Europe is starting to pass this first test. It is all about the late winter, though. It is about that February contract, February 2023 contract, and then about refilling for next year. But if we do get through this year and we don't consume all of the gas that we have in storage, that will definitely set Europe up for a much better summer, and as we start planning for the next winter.
The challenge is, though, Eddie, that next year we're not going to have Russian gas at all. So this year, a lot of the gas in storage is Russian gas.
Right.
We may be using a lot of LNG now, but we filled the tanks with Russian gas. That's not going to be there next year.
Yeah, so I think you're right. I think the problem is that if we do consume all of it, if we do go to the lows that we saw last year, then I think we're going to be in trouble. But at the moment, the drawdown is quite slow. I think the coming days are going to be really interesting. But there's one big thing that I think traders need to remember, and everybody who's now newly watching gas markets and power markets, is that gas prices can't collapse. Even if we have high slow drawdowns, even if we have high storage levels going out of the winter, gas prices can't collapse, because then you will no longer attract those LNG flows from the US. Right. LNG is an expensive thing compared with piped gas. So we will need to see a premium over the rest of the world to discourage consumption and to attract new supply. Yeah. And I think Europe, therefore, will pay more for its natural gas even into next summer, even if it does, even as it conserves gas this winter.
Which is part of the problem with the whole gas cap that Europe is looking into for that exact reason. Like, you need to incentivize producers to sell there. Hey, Todd, if we actually get through this winter, though, what's the worry about complacency?